What's up, everybody? Today we are talking about fair value gaps and the only fair value gaps that matter. Okay, give me 1 second while I make sure everybody is on this call. This is a recording here. All right, about 225 people. Nice. Should be another 100 people coming on, but okay, so in this video, we're going to be explaining what fair value gaps actually are, and then I'm going to show you a little secret and show you which fair value gaps that actually matter and which ones that you should trade. This stuff has taken me a long time to actually discover, and I am sharing it with you for absolutely free. Okay, so please tune in and find out what is up. Okay, guys, give me 1 second here. What is up, everybody? We are going to quickly dive into what fair value gaps are the most important. But first, in order to be able to get to that level, what we need to do is find out what a fair value gap is in general. This is going to be really quick. I'm only going to spend 45 seconds on this slideshow because personally, I hate slideshows. I think they're super boring, but it is an important way, an easy way to get the information across to you, okay? So what is a fair value gap? So here's what actually happens. In normal trading, every price level gets a chance to be traded, but sometimes a big buyer, like a bank or hedge fund, enters the market. Their order is so big that it actually pushes the price up or down really fast. It moves from one price to another without filling orders in between. Now, why does that matter? Okay, traders actually think price might come back to quote unquote fill in that skipped level, kind of like fixing a pothole. So they look for price to return to the fair value gap, then make a move away from it again. Okay, so let's get into the chart so I can show you exactly what it looks like so we can go into what fair value gaps I look for and which I think are the most important. Right, so here we are on the chart to give you a visual representation of what a fair value gap is. Won't bore you with this for too long, but bear with me before we get into the good stuff, okay? So a fair value gap, 3 candlestick pattern here. We have our first candle, our second candle, and our third candle. In between the first and the third candle, you can see that there is a gap here. This is what we call a fair value gap. If you look over here to the left, you can see these 3 candlesticks, no gap in between. These 3 candlesticks, no gap in between. These 3 candlesticks, no gap in between, so on and so forth, okay? This fair value gap, like I said, is created by those hedge funds that push price so fast that it does not give people a fair chance to trade inside of this gap, okay? So now that we know what a fair value gap is, why it matters, and what people look for, like I said, people, when they see a fair value gap, they look for price to kind of come into it and then kind of slowly make its way out of this fair value gap and go higher, okay? But what the biggest confusion for fair value gaps is which ones do we use? There are so many on the chart and we're not sure which ones to use. Here is a fair value gap. Candlestick 1, candlestick 2, candlestick 3. We have our gap right here. Right? Again, another one here. Candlestick 1, candlestick 2, candlestick 3. We have our gap right here. So we see them everywhere, but not all of them work. Now, which ones do we use? Which ones hold the most weight, okay? And that's what we're about to get into. This information that I'm about to give you is stuff that I have worked on for so long, and it took me so long to actually discover. So please take it seriously. Watch it. Let me know your thoughts, okay? I'll be right back. World of rebalanced fair value gaps. The only fair value gaps that I trade. I showed you what a fair value gap is and why it matters. Let's look into the most powerful fair value gap to trade. So before we look into the visual representation of it, we have to go over some rules. So first off, for a rebalanced fair value gap to be considered one, an FVG must be created. That FVG must be filled without being closed outside of, meaning price must stay inside of that fair value gap and not close outside of that fair value gap. I'll go over the visual representation of it, but for now, let's move forward. A break of structure must happen and a new high or low must be created from that fair value gap. Mark out that fair value gap and wait for price to re-enter and use your preferred entry method to execute. Right now, this video is not about my entry method. That'll be for another video, but let's get into the visual representation. So first one that we have here, okay, let's get rid of this. All right, so the first one that we have here, so we have our fair value gap. This is our 3 candlestick pattern here. Let's mark it out. All right. So as you can see, we have our fair value gap here. Now, rule number 2, that fair value gap must be filled without being closed outside of. So here on this candlestick, you can actually see that price reacts off of it. Right here, price reacts off of it and does not close outside of it. So if the candlestick would have came down here and closed outside of it, we would not have considered that a rebalanced fair value gap, okay? So price does not close inside of it. Rule number 3, a break of structure must happen and a new high or low must be created from that fair value gap. So we are going to be marking out the most recent high here, which is this one here. And as you can see, after price goes ahead and fills this, a new high is created right here, and a break of structure happens with that candlestick closing above the previous high. Now, what we are going to do is mark out that fair value gap and extend it. And as you can see here, once price comes back into this fair value gap, take off. This is where you would drop down onto a smaller time frame and look for your preferred entry method. But let's go over that again. An FVG must be created. We have our fair value gap here marked out. That fair value gap must be filled without being closed outside of. We have that fair value gap filled right here. A break of structure must happen and a new high or low must be created from that fair value gap, which we have right here. And we mark out that fair value gap, and you can see once price re-enters that, takes out this previous consolidation, all these lows here, and takes off, okay? Now, let's look at another example. I'm going to give you 2 more examples so that we understand exactly what I am talking about. So we're going to go through all of these rules, okay? So here we have our fair value gap. Delete this. So here we have our fair value gap. Boom, candlestick 1, 2, 3, extend it out. We have FVG must be created. We have our FVG. That FVG must be filled without being closed outside of, which we have here. A break of structure must happen and a new high or low must be created from that fair value gap. So here you can see price comes down, creates that high, boom, and we have our break of structure to the upside. Now extend that fair value gap out. As you can see, take off. This is where you would drop down. This is the 15-minute time frame. So for me, I'm a scalper. I would drop down onto the 1-minute time frame and look for my preferred entry method to execute. And we're going to go over our last example here. And this is a good one because the fair value gap is quite large. All right, so we have our fair value gap here, which we are going to mark out. This is a bearish fair value gap here. So we're going to mark it red. So we have an FVG, rule number 1, right? An FVG must be created. That FVG must be filled without being closed outside of. So here you can see we have that fill of that fair value gap. This is our nice reaction here. And a break of structure must happen and a new high or low must be created. And we have our low here. Our break of structure right here with the close of that candle. And what we're going to do is extend this out. As you can see, price comes and plays around in that area for quite some time here. And take off. Absolutely melts from this area here during London session. Right? So this is what a rebalanced fair value gap is. You know what? Let's go ahead and see if we can find one more example for you guys. All right, so actually right here, easy peasy lemon squeezy, we have our fair value gap. You should understand the rules by now. We have our fair value gap here. Use our green. We have our fair value gap that is created. That FVG must be filled without being closed outside of, which we have here. A break of structure must happen, which our high is created right here. Price closes above that high. We have our break of structure. Extend that over, and guess what? Takes off. All right, and there you have it, guys. Rebalanced fair value gaps. The most powerful fair value gap in my opinion. Like I said, it took me a while to discover this, so please just go on your charts, 15-minute time frame, 1-hour time frame, 4-hour time frame, 8-hour time frame, 1-day time frame, monthly, weekly. and go ahead and start highlighting these out to practice them and just see how price reacts. Of course, not every single one works, but when it doesn't work, we're going to talk about that too, because that's something else, which is actually my next video, the best inverted fair value gap to trade. And the video after that is going to be my entry method. You'll see what I mark out, and I'll also give an introduction to the indicator that I created here, which is also part of my entry method.